Welcome to the next episode of DeFi Drip, the series where we talk about all things coffee and changing the world of finance. My name is Cassidy Daly, and today we're joined by Jake Lynch, investment researcher at L1 Digital. Today we talk about his experience with DAOs and governance, the importance of credit to the financial system, and how Centrifuge is bringing this on-chain and into DeFi. Hey, welcome to the show, Jake. So
Good to be
first things
here.
first, what's your relationship with coffee? I mean, what's your go-to drink?
Yeah, I would say it's an intimate relationship with coffee. It started a few years ago. It's been on again and off again. But most recently, I would say that I'm into like the fancy hipster stuff. So I have my big trouble with me right now, and this was a V60 pour over.
Nice.
I'm into the press. I don't have a press myself, but I do have to give a shout out to my favorite guilty pleasure coffee, which is certainly Dunkin' Donuts.
You've always got to have a guilty pleasure in there. I'd say mine actually, when I lived in New York, was mud coffee that I lived just down the street from. But these days, I'm mostly using my AeroPress, which I actually brought over today just to show you guys.
I love it. I love it. That's a sign of a true coffee lover.
But yeah, nice to have you on the show. I think maybe to start off with, can you take a moment to introduce yourself to the show and just tell us a bit more about your work?
Yeah, absolutely. Yeah, so right today, my what I do is I work for L1 Digital, which is a Swiss fund focused purely on crypto. We do two different strategies or vehicles. One strategy is a fund to fund strategy, where we invest in different managers across the space, primarily focused on like risk on managers, so directional, typically long only, but there's long short and systematic strategies in that portfolio. The other vehicle that we have is a VC vehicle. This is our second one. We raised it in November 2021, which was peak bull market. So it's about 180 million, and we manage that vehicle a little bit differently than others in that we invest about 30% of that into early stage or niche managers. So there is a fund of funds component to it. And then the other 70% goes into direct investments that are trying to typically follow on or look at like a Series A or later stage growth investments. So we're one of the later stage investors as far as crypto goes. As far as traditional finance goes, I wouldn't call it super late stage. But so that's what we do at L1 Digital, and we have a generalist mandate. My background specifically is pretty much been in crypto since I left university. I studied economics, and I went into an accounting job out of school working for the largest residential real estate developer in the U.S. And within maybe about a month of that job, I realized that wasn't where I wanted to be for the rest of my life. And so I started looking online for. I was always very into crypto since I was in college. And this is started using it in 2013 or so. And I found a job on Reddit that was a part-time job that was looking for people to do ICO due diligence for what was at the time like a self-regulatory organization. So what we did is we DD'd ICOs that were coming on the market to see if they were scams, to see if they were interesting whatsoever, to see if there was some problematic token econ, all these sorts of things, and we would post it on Concourse Q, which was like a Wikipedia for ICOs. So I did that for about a year before deciding that I really wanted to go into the space full time. And this was around 2018 when I decided to go into the space full time. And at the time, you really only had two options. There weren't a lot of marketing or BD or accounting roles. I don't even think accountants knew what they were doing at the time in that space. So there was no way to be an accountant there. But you could be a investor / trader, or you could be a developer. and it was a little bit closer to being a trader than I was a developer. So I decided to try that out and give that a shot. I called up a few friends of mine and we set up a small prop shop and started trading. We did all sorts of things. We started out in the market making side, switched over to like the long short and long only, and ultimately the yield farming side before getting to about 3.5 years of doing this, where ultimately I got burned out. And this is the thing that a lot of people don't realize: the difference between trading in crypto and trading in traditional finances is that in crypto, when you're trading, you have 3 times for every 1 day that you're trading, you're on the clock 3 times longer than somebody outside of crypto, because it's a 24-hour cycle. So FX traders can relate, but traditional traders don't. And so burnout's a lot higher there. I decided, hey, these tokens aren't getting any cooler. It's kind of leveling out here. And so I wanted to try to find something new that I'd be interested in. And to me, that was governance at the time, what I called low hierarchy governance, or like what most people colloquially refer to as DAOs. And so I started trying to get involved in many DAOs to figure out, what was good about them, what made them work, what didn't make them work. Ultimately, when you go down this path, you also end up in corporate governance and studying corporate governance, and realizing that there's a lot of really good things in corporate governance, and you don't want to throw out the baby with the bathwater. And so I did that for a bit, where I got involved with Threshold DAO, which was the product of a merger between Keep and NewCipher, which were 2 very early projects in the space. And I thought a DAO merger was just a fascinating idea. I had to be a part of it. So I joined it up with them, and initially trying to find a place to participate. And where I became most useful was in kind of developing the framework for the DAO. Not just the framework for like the governance, but the rules, like the bylaws, as well as also the treasury. How is the treasury going to be managed? How to think about the treasury there. So I still help out with Threshold. In addition to that, I've done a few other things. I helped start an organization called Spearbit, which is a marketplace for security auditors, for freelance security auditors or researchers. And I also helped start the Boston DAO as well in this previous year, where we put on, we hosted ETH Boston for the first year since 2019. So that's the long and short.
That's a really interesting journey into the space. So how does that translate into your work today with L1 Digital?
Yeah, I think it's really about, with the generalist mandate, we get to focus on what we find particularly interesting. And to me, that seems to be like DeFi and DAOs, right? And the stuff that's on the DeFi side is obviously interesting to me because I have this accounting background and a big real estate background coming from my family and whatnot. So the RWA stuff has always been really appealing. When I was at Lennar, the first thing that I pitched the organization, and this is a big, Fortune 500 company, the first thing I pitched them was, hey, housing market is like every system that you guys are using today is totally broken. There's no reason for title insurance if you're using a system that actually can keep track of title. And this is something, blockchain is a really good solution for this. And so like the RWA side has always been appealing to me. So that's definitely influenced it. The DeFi primitive side, definitely from the trading angle, was something that I got into very early on. Synthetics was one of the most interesting projects out there, from, in the early standpoint, and have been paying close attention to like that derivatives and the options market and all this type of stuff since then. And then the DAOs have been interesting because I think, as most people understand, DAOs aren't really, in this current state, aren't very investable, despite a lot of our attempts to make them investable. And they end up, the more investable they are, the less they look like what we actually think of as a DAO. And so this has been kind of something that I've been working through, and I'll be honest, we don't have an implementation yet that we're totally comfortable with from an investment standpoint. And so for that reason, the other focuses that I've been paying attention to are kind of like on the privacy and security side, pulling from Spearbit and from Threshold.
So, I mean, you do work with a lot of DAOs nevertheless. So can you give us an example of the ways that you are supporting them that you find to be pretty helpful?
Yeah, and when I say DAOs aren't investable, I mean that the DAO as itself is more of a liability than it is an asset in this current state, right? And what we're trying to do is we're trying to turn that into an asset because it can be. So, what is an example of like how to support them? To give you an example from the Threshold side, when they went through this merger, they go through this process that's a really challenging process. You have to have like two loosely formed organizations come to an agreement on what the valuation of another organization is. This is hard in a centralized fashion to do, right? And it's very hard in a decentralized fashion. Shockingly, everybody was okay with saying, how about we just say we're equal? That was amazing, right? And this is one of the things about this industry that I always find fascinating is like how optimistic people are and, positive sum thinking they are. So that problem was solved, but then you're going into a situation, and on day one you have a treasury, and this is in the bull market, right? So on day one you have a treasury that's in the order of $150 million in terms of governance tokens, and we all know that doesn't equate to real cash. And then this treasury, because it's all in governance tokens, has something like a 20% intraday volatility. So I'm looking at this, and like the first thing that I think is somebody has to figure out what we're going to do with this, right? Like this cannot just be ignored. This is a huge amount of assets, but it's completely mismanaged, and there needs to be some structure for that. So we went across developing kind of a treasury framework, and it broke down into three parts, right? So the main goal is to stabilize it and turn it into a sustainable portfolio, right? When you think about internet protocols, you want to build something that is sustainable. So let's say it costs about 5% in terms of staff, legal fees, etc. per year of your portfolio in order to sustain the protocol or grow it. Then you want to be spinning off about 5% in yield per year, right? And that's how you have to think about it. You have to think about it like a school endowment. So taking a step back to the challenge you have $150 million of governance tokens, and you have $0 of liquidity for those governance tokens. So effectively, you have $0. And so you need to figure out how do you diversify this, right? And so diversification comes in multiple steps. The first step is like you need to find some OTC buyers. You need to find some people who will take somewhat of a venture bet on this, or you can find some sort of debt, right? And the debt also works if people are long-term optimistic on it. So you can either borrow at a very low rate, and you have to do it at a very low rate, or you can essentially sell clips, right? Large clips. And this is how you start diversifying, and then immediately you have to turn this into liquidity, right? So you're putting this into liquidity because the DAO is in the best position to be the liquidity provider, because in the worst case of impermanent loss in a liquidity pool, the DAO ends up with their governance tokens back, which is not a bad thing, right? And people don't realize that is a bad thing for the user, but that's not a bad thing for the DAO because they're fully recapitalized. And so you have to build this liquidity, and how do you build this liquidity? Well, in this era, the strategy for that is like through liquidity incentives and strategies like that. There's additional steps involved in this process, but for the sake of not belaboring the point, the other stuff that you need to do here is you really need strong transparency, and you need really good reporting. Otherwise, people won't really notice what you're doing with the treasury, right? If you're managing the treasury in an incredible way and nobody notices, it doesn't really matter because the token's not going to go up.
Yeah. I think responsible DAO treasury management is something I've been thinking about quite a bit
I
recently.
noticed.
Yeah.
I
So I think
noticed. Well, tell me about what you've seen with it.
um I think it's grown quite a bit over the years. It wasn't something that anyone thought was necessary originally. And I think part of that was under the guise of, being maximalist to their own project or to ETH in particular at first. And I think what there was a failure to realize for a while is that one can be both. You can be a maximalist and have a lot of faith in your project's token, in ETH, in any given sort of asset that they're holding, and still have responsible portfolio management strategies. And in particular, with this focus of existing long term and having a treasury that can actually support your project means having a diversified portfolio. And I think one of the biggest things that's changed recently has been actually having tools to be able to do this on chain, including Centrifuge, in my opinion. So I think we'll hopefully start to see a bit more growth in that direction. But I'm curious, I mean, so you've been researching DeFi for the last 6 years, right? Is there something that you really learned that you find has influenced your thesis and strategy over the years?
Whew. That has influenced my thesis and strategy. You know, the space has evolved a lot, and there's there's kind of this. There have been these phases to this industry where you have like kind of like waves going in and out. Where when the wave goes out, you're like, that will never happen again, and then it happens again, and it constantly surprises you. So I don't love to like stand in the current bear market and say we're never doing that again. Um, because like one of the lessons that I've learned is that at the end of the day, one of the core parts of DeFi, and this is unignorable, it like there is no way to avoid this, is that DeFi is a casino for a lot of people, right? And that this environment is currently sustained by either synthetic incentives or by like zero sum games that are people on an exchange trading against each other, going up and going down. Um, but what this has really taught and been pushing to almost the entire time and trending in the direction of is that there needs to be a more sustainable uh, mechanism for growth, right? And that pretty clearly to me is that it comes from these efficiency gains that you have on certain DeFi protocols that are tapping into capital that's outside of crypto, right? You know, Centrifuge is a really good example for this because when you look at why Block Tower is doing something like what they're not doing that because of incentives. That's certainly not the benefit that they're getting beyond their peers. They're doing that because they have a legitimate competitive advantage from doing this, right? Like their fees are lower to do it. And something like that actually grows an economy in a healthy way. And so this is kind of like one of the lessons learned is like, how do you focus on and invest in the things that are actually generating healthy returns, right? Like that are attracting users that are organic users. And like organic users are like not just in crypto but also in tech broadly are a hard thing to find, right? When you look at all of the competitors to Twitter, the only one that has ever stood out so far is the Threads thing, right? And the whole reason the Threads has kind of stood out and kind of taken, like grown out of this is because they had these organic users already and they just ported them over. So like if this is a world that we live in where Facebook is going to say, hey, we have these users, let's just do everything else in the world, right? And we'll just bring organic users all the way across. That's not a great situation for any of us. So one of the things that we really do have to focus on is how do you grow this organic user base, right? And I think that's one of the things that we've been particularly focused on.
I think that makes sense. I think, with things like DeFi being a casino, that was a little bit easier in that bull market of just, having the users that were there. And so they were ready and willing to jump into something new. And I think now we're turning over into, like you said, actually having economic reasons and real use cases for users to start to come into the space, and hopefully it starts becoming more and more of a flywheel in that direction.
Yeah, hopefully. I mean, like the ultimate form of this is that it's really a seamless experience between DeFi and regular finance, right? The ultimate form of this is that it's not the crypto people versus them or that any of that narrative, right? It's ultimately that like, yeah, everything that should have it is better because it does have it, and everything that shouldn't have it doesn't have it.
Yeah, that makes sense. I want to switch gears here just a tiny bit. You recently gave a talk at one of Centrifuge's contributor calls about the challenges and opportunities in DeFi. It was a great talk, by the way. And you focused on the importance of credit. So I'd love if you could walk us through this 10,000-foot perspective on the importance of credit in a financial system.
We did this exercise about a year back where we looked at like trying to map out the sectors in the space, because over time I think this has been something that consistently gets neglected, and semantics make it very difficult to kind of agree upon. And so we did this internally with our team, and then we put it out in the public so that people could fork it, could iterate on it, could put it for their own purposes, because obviously ours are for investing purposes. And when you look at the DeFi side and the CeFi side, they look very similar, and that makes a lot of sense, right? So like to kind of walk you through the prongs of the DeFi side, you have currencies, Bitcoin being one, stablecoins being one, etc. You have exchange, and now this is one of the major differences between DeFi and CeFi is that we chose the word exchange rather than exchanges, because the verb is indicative of P2P, whereas the noun is indicative of like a centralized location that settles for the people. So in DeFi, we call it exchange. In CeFi, we call it exchanges. Then you have derivatives, which is, today kind of like this casino like market, but it does have legitimate purposes, right? Like in traditional world, you have derivatives in order to hedge your exposure for companies so that they can have sustainable growth. Then you also have asset management. Asset management comes in the form of, strategies that people are deploying, like these vaults, like urine vaults and whatnot. Custody, so you look at safe, and this would fall into like kind of the asset management strategy. And then also staking, right? Like all the LSDs is definitely asset management, right? This is what you're choosing to do with your assets. So it's a way to safely host it. And then lastly, and right in the center of all of this, is the lending and the money markets. And the reason it's kind of in the center here is because lending and exchange are very closely related in that, like, if they would be like the heart and the lungs of the economy, right? And the reason that's the case is because it's all about money velocity. It's all about transactions, right? Economies grow as there are more transactions, and they shrink as there are less transactions. And that's a very simple and unavoidable truth, right? And so when it comes down to where lending is in the state of the crypto economy, it's super obvious that it is hurt. It's struggling, right? And it's struggling not so much on the permissionless side. The permissionless side has always been over collateralized and has always worked, and it's capital inefficient, but it works very well. But it's really struggling on the under collateralized side, something that actually works fine in traditional finance. And because of this, you see that the economy is kind of shrinking and slowing down, and it's a challenge, right? And this is kind of what we're facing. And so in the wake of FTX and whatnot, where you have these crypto capital markets that have completely shattered and like been rebuilt, lending becomes one of the most important areas to rebuild on.
Yeah, I think that makes a lot of sense to me. Would you say that DeFi is really fully addressing this need for lending? I mean, you said it's not quite there yet, but do you think that we're building towards that vision?
Yeah, absolutely. I'm very optimistic in DeFi's ability to cover this area because the quicker we iterate through these lessons, the quicker we break down these walls and we figure out which platforms we can trust and which ones we can't trust, the better and the quicker we're going to grow. I mean, there's that really good chart from RWA.xyz, right? Where you see this gigantic bubble and then like a steady line of growth. And that gigantic bubble is all the things that just didn't make any sense to begin with. But at the bottom, like literally underpinning it is Centrifuge with steady growth, not just through the bull market, right? But like steady growth in the wake of the bull market, in the bear market, in one of the worst rate environments that we've had in recent memory. So I think there's, when you can get rid of the noise like that and you can start to see kind of the patterns, it's optimistic. It paints an optimistic tale. And ultimately what will happen here is that, rates will go down and people will want to lend more, right? Because right now it's not incredibly competitive to lend in a DeFi platform because the US government is willing to pay so much for you to lend to them. So once that changes and once that inverts, we'll see a lot of this lending come back to life.
I really love this graph that you mentioned. I think for me, it gives me a lot of optimism in the work that we're doing at Centrifuge. But maybe you could walk us through, why do you think Centrifuge has actually been able to grow through this bear market? I mean, how do you position Centrifuge within this opportunity in DeFi to grow credit infrastructure?
Yeah, I think maybe this would be a good time to kind of bring up like the piecewise part of the talk. So building markets is really hard. And there are certain markets like three-sided markets, which are incredibly difficult. Like Grubhub is like a three-sided market or Uber Eats or whatnot, where you have like a driver and you have a restaurant and then you have a user, like an end user. That's a crazy problem to solve, right? Because you have a three-way cold start problem. A two-way cold start problem is also hard, right? Like you need to create, you imagine kind of like this, you can kind of imagine like this Scooby-Doo hall where somebody goes in one door and like looks in the hallway and nobody's there, and so they leave, and then like somebody opens up and like looks and nobody's there, and then they leave. And that's like what a two-sided market looks like at the beginning, right? Where you have both sides are coming to the table, but they're not syncing. They're not coming at the right time. And so you need to find one that's super sticky. And you just need to start with one thing that's super sticky. And this is what Centrifuge did very well, right? Is they found crowd lending. And Aave was also with them in 2017. Compound was with them in 2017. And the idea was, hey, if you get a lot of people together who are accredited, who are completely regulatory friendly, but if you get a lot of people together, you can lend at the same rates and the same size as a small bank, right? Or a medium bank. And you can compete with them. And so this kind of innovation created like this continuous supply side, right? So even if somebody left, there were still people there. And this creates something that the demand side can latch onto, right? So then all of a sudden, of course, a high quality borrower coming in, right? And that high quality borrower in Centrifuge's case was really, there were a few of them, but the one that sticks out, I think today is New Silver. New Silver coming in, doing exactly what they're telling the people they're doing, performing consistently, transparently, talking with the people, doing it in like a DeFi way, not doing it in like a banking way where you're like, put on a good show for your bankers and then hang up and then never talk to them again because you're scared that they'll pull the credit line if you talk to them when you don't need to, right? They're like New Silver is there on the governance calls. They're talking to people who are borrowing from them, right? Like they're an active borrower who actually has a stake in the community. So now you have a high quality borrower. And then what happens next? Well, you see somebody like MakerDAO say, hold on a second. We are going through the same treasury diversification problems that we talked about earlier today. And we need to diversify our sources of yield. And not only that, but like we're also not great candidates to go to the US government and say, can we get a T-bill? Because that's simply not going to fly, right? Like we're a competitor to the US government. And so we can offer, at competitive rates to the government, right? To government bonds. And so this is where Maker comes in, and Maker says, let's backstop the senior tranche on the new silver pool. And all of a sudden, you now have a super high quality lender, right? So you've got a really good quality lender, number one. You've got a really good quality borrower, number one. You've got a new lender, number two. Now what happens? You find a new borrower, number two, right? And that new borrower became Block Tower, and Block Tower has been paying attention to Maker for a very long time. And this opportunity has probably always been there. And it's just been a matter of trying to get the regulation in place, and then also a lot of the work that the Maker DAO, real world finance unit did to make it, to talk with lawyers and to put out like a lot of almost open source legal work to make this feasible. And that was pretty much all charity, right? Like similar to how OpenSea dropped Seaport as a code base. Like that's not their IP anymore, right? And so this is also, once again, only stuff that happens in crypto. You never see that in the real world, except if you want to talk about like maybe like Linux or something. But yeah, so then all of a sudden you have Block Tower coming in, and they're a super high quality borrower here. And so what's next? Well, now we have to go back and we have to go and find the super high quality lender. And why is that a challenge? It's a challenge because this is a very difficult environment to be a lender in. And it's a very easy environment to be a borrower if somebody is offering the right rates, because cash is, very hard to come by today. So this is an interesting challenge to face, and perhaps one of like the first real macro challenges that we've faced in crypto. Typically we used to be a little bit segmented from the macro challenges. The only thing that would happen would be like Bitcoin would go up or down because rates go up or down, right? But now we actually have to compete with them on rates. And so this is a novel challenge, and I would say that's where Centrifuge is sitting today, is trying to grapple with this and play the time game, really.
I think that's a really interesting perspective, looking at it, from the perspective of our marketplace challenges. I would also say, a big element of how Centrifuge sticks out within DeFi generally is focusing on real world assets. And so I'm curious what role you see real world assets having played within our journey there.
So I'm going to side with Lucas and say that we need a new name. I think that real world assets is like super like pejorative or something, right? It's like, no, all of your other assets, they're fake. But I see the role of real world assets. I mean, I'm not going to say anything novel here, right? To me, the role of real world assets in this space is to grow the pie. And particularly what it means is to grow the pie for access to these assets globally, right? I don't think, Block Tower is a great example of a wealthy, well-established organization using real world assets to make more money. Our ideal world is that, yeah, sure, that's part of it, but that also people who don't have access to these assets are getting access, right? And so I think this has been like kind of a necessary evil that we've been dealing with in the Centrifuge community, is that like, yeah, this Block Tower pool is like, it's a private pool. It's just set up between them and Maker, right? And that's a reality. And if you want exposure to that, you should go through Maker to get that exposure. You can't go through Centrifuge. But to me, like, the real goal of Centrifuge is to kind of give this exposure to people globally. And so I think, we invested in the company Groma, and Groma does real estate on Onchain. So they're working on bringing a REIT on Onchain. And, Seth, who runs Groma, has a great saying, which really makes sense when you think about it, which is, the world is a better place when everybody owns a piece of it. Like, places degrade when people are all renting, and they just trash the place and it's not theirs, so they don't feel any, you have the tragedy of the commons, right? And with real world assets, what you can do is you can start to give pieces of the world to people so that they think and that their incentive aligned with it.
I think that's definitely a big part of our vision, is being able to open up access to this part of the financial system. And I guess it's really a thesis that we hold, and I think a lot of the people that support Centrifuge hold, that financial systems are public goods, and that these sort of financial tools should be available to anyone, should be open access. So hopefully that thesis does work out. I think, a big part of what we've done with Block Tower is bringing their credit fund on chain using Centrifuge. And I'm curious how you think about generally bringing credit on chain.
Yeah, I think it's a really interesting question, right? Because this is one of those ones where, well, let me dive into it first. So when we talk about bringing credit on chain, we're not always talking about the same thing, right? We can talk about bringing private credit on chain, and we could talk about bringing public credit, which is like government debt on chain. And public credit is an interesting thing to talk about bringing on chain because it happens to be a very efficient market. It's the most liquid market in the entire world. There is zero slippage here. The price efficiency is incredibly strong. Most people everybody in the United States has access to this. And honestly, most people who are interested in trading this do have access to it through their banks because it is one of the most popular assets in the world, right? So it's not a pink chip in Canada that you're trying to buy. You can call up your bank no matter where you are, as long as you have a bank. And that's the caveat, right? If you don't have a bank, you're not getting access to it. But it's very accessible, public credit. Now, yes, there are systematic issues, right? Like there are system issues when it comes to public credit. How do you transfer the ownership of it to the different places? The clearinghouse, can you trade it off hours? These types of things, small inefficiencies. Ultimately, I'm not entirely certain that you need a blockchain to solve this. And this is where I actually disagree, like internally with some people, with some of my colleagues at L1D. We have this debate all the time. And I also have this debate with people outside, because I actually think that, like, if it comes to putting bonds on chain, the only reason people are doing that is because they want to ride the casino ride more, right? Like they see it as really good collateral. They're going to lever up against it. And now you have like these institutions who are levering up against public credit and whatnot. To me, what would make a lot more sense is to put emerging markets public credit on chain, because emerging markets do not have, when you think about what the blockchain is, it's the cost of trust, right? You're paying for trust. And with the US government, is the US government ever going to say, hey, sorry, that's a counterfeit T-bill. We're not going to pay that out and be lying to you? No. Will they say, yes, you're North Korea, we're not going to pay that out? Yes, they'll probably do that. But the blockchain's not going to help you either way. But in the case where you're talking about an emerging market that maybe has a dictator or has something like this, and you want to give them some chance, because, just because they have a dictator doesn't mean they should be removed from the global economy. You want to give them some chance to kind of access the global economy and to get credit from crowdsource it. I think it does make a lot of sense, right? I think you do have some type of third party, which is Ethereum or Polkadot or whatever, stepping in here and saying, hey, we're going to be your ledger because we don't trust your ledger, to be honest. And that will give you access to more credit. When we talk about private credit, it makes a ton of sense to be on chain. And the reason it makes a ton of sense to be on chain is because it's so fragmented, right? If you ask the average person listening to this today, and this might be like the worst subsection of people I would pick in terms of like not knowing this, but like if you ask the average person listening to this, how are you going to get like a private corporation bond? They wouldn't know how to do that, right? Because these markets are not like super accessible. They're not like super publicized. And also, they're not really going to be able to diligence that bond, unless they're doing huge size, right? Like that company is not going to give you their financials unless you're talking about at least a couple $1 million of a bond. Um, and so what you can do with the blockchain with private credit is, one, you can bring all of these things on chain to compare them. And then two, you can crowdsource the funds for them to make it a competitive offering, right? And both of those things don't apply to public credit. So that's why I struggle with the public credit thesis, although it's extremely popular right now. But on the private credit thesis, I'm fully bought in.
I fully agree with you on the fact that public credit coming on chain doesn't make it any more efficient of a market. Those markets are actually pretty transparent, pretty efficient as it is, already within TradFi. The reason why I see to bring public credit on chain is rather to actually have access to it for on chain users. So I actually think that's the real reason why public credit has blown up within DeFi most recently, is because a lot of entities are sitting with a lot of stables just sitting on chain, not wanting to put it into DeFi protocols anymore. And this public credit happens to actually have really attractive yields for very low risk. And so I think it's actually the demand for on-chain stables to access this public credit that's making this public credit come on chain, rather than actually wanting to improve any element of TradFi, which is what a lot of projects like Centrifuge are focused on.
Yeah, I mean, when you think about like the redemption costs of USDC or USDT or whatnot, right? You actually do add some, you can kind of add back that efficiency, because if you're going to be going on off chain, and like that, you expect to be deploying capital on chain soon, but you have a park somewhere, it definitely makes sense, right? It definitely makes sense. Now, the challenge, and now you're getting at something very interesting, which is the opportunity cost on chain is different than the opportunity cost off chain, right? Off chain, I have stables in a bank, no opportunity cost to go into T-bills, right? Like if I go into UST's 1 month duration, it's a no-brainer to me. I'm actually like net winning because I reduce my counterparty risk, right? I narrow that down to the US Gov. If I have my stables on chain, well, my opportunity cost now is staked ETH. And so this is actually like a really interesting relationship that has appeared in this past year, which is the relationship between the yield on staked ETH, especially if you hedge it out, because you can hedge it out. So the yield on staked ETH versus the yield on T-bills, right? And so these two right now are really close to each other. They're both sitting around 5.5 to 6%. And that's, now keep in mind, that's not on 1 month duration. On 1 month duration, you're getting way lower than the 6%. So imagine what happens when this government yield goes much further down, right? A lot of these people who are interested in these T-bills on chain, when the government yield goes down, are going to see the ETH yield and they're going to say, "Come on, I don't want that government yield. This ETH yield is way better." And then naturally you'll have some like equilibrium effect where money flows into ETH. The yield on ETH net goes down, and then you find equilibrium again with the opportunity cost. So I think that's something really interesting that we should be paying attention to. But this is to me, this is a classic grass is greener, everybody's too slow move. Like by the time we build up the infrastructure to get everybody into these govs, it's already going to be the time when you want to switch back to the LSDs.
I think that's a really good take. I mean, to me, that's actually the standard take of a DeFi trader, of someone who's been in the space for a long time and is comparing the yields that they can make in DeFi protocols or in staked ETH to these a lot more traditional financial instruments. And I think I agree with you that we're probably getting over this cycle where we've actually had a lot of hype to build these tools. We're probably not going to get these DeFi investors to really pay attention to this for very much longer. But I think it already had a really important effect on being able to create hype to build these tools in the first place. And I think for me, what's important is that it's going to be there for the next cycle, and that these are going to be long-term tools that everyone has access to, and you can build a responsible portfolio around. That's
100%.
everything, let's say.
100%. And with, with like something like vaults and like you bring in the account abstraction, you could do some really cool stuff. Like you could make some sort of blended and managed account where you're optimizing the yield regardless of like an evergreen vault, right? So one that is, if your yield is better in ETH staking, then you hedge out the ETH and you're staking ETH. And if your yield is better in T-bills, then you have the tokenized T-bills and you're in that, and you're just switching between the two depending on what the Fed wants to do, depending on what ETH wants to do. That's a really cool product. And I think that like that becomes like this very interesting like philosophical product of like, this government and network state bond combined.
Yeah. I think what I would add there is also centrifuge pools. So specifically having private credit as part of that strategy. So you've got public credit, private credit, and other DeFi native strategies.
Well, private credit's always the juiciest. Anybody listening to this definitely knows.
Well, I guess, so looking ahead, I'd love to hear a little bit more about how you think this ecosystem will evolve in the near to medium term.
Yeah, I touched a little bit on this, but really nothing new to say. So the way that I see it playing out is, rates will go down despite what people think. People will want to play more and more with their money. They want to take more risk when rates go down. Somebody will launch something super cool but kind of scammy. I thought this was going to be ordinals. Turns out it's not. The timing didn't work with the macro. But I did think it was going to be ordinals. I kind of bought the bait. And maybe in hindsight, we'll see it being that. The people get super interested in crypto again because, there's this new thing that pays you to take steps, or there's this new thing where you can just lever it up 7 times, and then you can make some like crazy yield. And then hopefully by then the institutions will be comfortable enough with interacting with crypto that they open it up to their clients, like to their users, right? They allow the traditional banking system to tap into this. And this is something that we're definitely seeing. We're starting to see is that like more and more these banks are getting calls from their clients, and their clients are saying, hey, I want exposure to this on chain. And the more that they get these calls, the more that they see the money adding up, right? And at a certain point, and like I said, these are like waves going in and out. And at a certain point, the waves stop going in and out because we're completely underwater, right? And like now the question is it this next cycle? Is it the cycle after that? That's that's a multi-billion-dollar question, right? But to me, it's pretty predictable that we'll go down that route.
I would say so too, for sure. I'm curious, I guess, within that, what you think the biggest challenges and opportunities are for DeFi generally.
Yeah, I got this question. And I immediately thought of a little joke here, but it's securities and it's security, right? So securities, like this whole regulatory stuff is a mess. It's an absolute mess. It's crushing us. It's killing us. We are losing so much time and innovation because of the lack of clarity here. Not only the lack of clarity, but honestly the lack of sincerity from the regulators. Like they are not sincerely doing their job. They're, you look at the Coinbase stuff and you're like, are you kidding me? These guys wrote you 30 letters and then you're going to hit them with a violation. Like, you're clearly being negligent. So until that changes, and I think we hope that it changes in 2024, I don't think any of us really believe that it will, because we've been very kind of like beat down in the past. Until that changes, we're going to continue to struggle here. But I do think that on that dark note, I do think that there is a lot of innovation that can be made through regulatory alpha, through understanding how regulation works, being the person in the startup who knows more than your competitors about regulation and navigating it, right? And working through it and being the first one to get through. And then the other security, which is this stuff is getting complicated on chain. When you look at something like Seaport, like OpenSea's code base, this thing is incredibly optimized. When you look at something like Uniswap v4 with the hooks, this stuff can get really dangerous. And it's getting very cool, and it's getting very, very usable. I mean, if you remember back in 2018, like going on Ether Delta or something, you were like, it was, from a security standpoint, it was probably way worse, but nobody cared because nobody knew how to exploit it. Today, people are really good at exploiting these things. And so to me, security is like one of the biggest concerns. And it makes a lot of sense when you think about it fundamentally. As an industry matures, security becomes more and more important. Kind of like how, when you're 20 years old and you have nothing in your house, you don't really lock your door. But when you're like 40 or 50 years old and you have a ton of capital and you've got a family at home and whatnot, you put the ring on the doorbell, and like you lock it really hard, and you have like, the alarm system, and you got all this stuff to protect your stuff. So it's only natural that as this economy like matures, it will be investing more and more into security.
I think, it's been a really great conversation with you today. I think we've only got a few minutes of your time left here. So I want to round it out with our last and juiciest question. If you could share one or two hot takes with us today.
I prepared 3 for you, and I'll try to like bat them off. I'll try to go quickly. I think these are hot takes. Some of them might not be, obviously, depending on who you are. My first one is that, like, I have gotten more and more bullish on Solana over the past year because I think that it has had its, come to Jesus moment with its distribution. Like, it has had its leader's head completely chopped off. And now it's growing from, imagine like, the forest has been burnt and it's regrowing, right? And so now you had somebody who was hugely accumulating a position in this. And the big complaint about this was it was centralized. And all of a sudden that position just gets dispersed in the wind, right? Like, so the centralization, and then you look at it, they have 3 validator clients on the way. They have 2,000 validators. Like, Solana looks a lot more decentralized than people give it credit for. And then also, if you talk to some of the teams there, you'll recognize that these teams are pretty awesome. They're really awesome. And the only reason they're still there is because, they really care about the project. And so that's one hot take. Seaport, this one's a short one. OpenSea dropped this crazy piece of code, open source. I don't know what it cost them. I would say it probably cost them like between $2 and $10 million of developer resources to develop. And then they just open source this thing. And I don't know if they know what the value is, or if they're kind of like they do know, but like they're not really letting it on. But the reality is, this unlocks a lot of things that we've been trying to do in crypto for a very long time. And it's similar to like kind of, I wish there was like a better example in crypto, but this is one of like the first examples where this giant innovative piece has just been given to people for free. So I'm really excited to see what comes out of that. I think that this is going to be a very interesting thing for people to fork on, like to build on and iterate on. And then my last take is that I am very bullish on governance tokens and governance itself. And I find a lot of people are really, really not. And the reason I'm bullish on it, and I say this all the time, but what I say is oil is the new gold, data is the new oil, and governance is the new data. Essentially, the way that I see governance playing out in crypto, if DeFi plays out the way I want it to play out, is DeFi plays out, it becomes kind of the rails for the economic system that we live on. You have banks working on it, you have countries working on it, you have all of these things. And so the way that I see it playing out is that the value of governance is not necessarily the value of what you can accomplish with it, but the value of what you can stop your competitor from accomplishing with it. So if you imagine, let's take like a really like crazy example, right? Let's say that Goldman Sachs and JP Morgan use Uniswap to settle. And the Uniswap token can implement changes to the protocol. So Goldman Sachs gets this crazy idea. Hey, what if we like kind of like whitelist our addresses? Or what if we do something sneaky so that we get some sort of better order execution or better order flow or anything like this, right? Like, what if we just do something a little bit sneaky? Well, then they're going to buy a bunch of governance tokens to do that. And what is that worth to them? It's probably worth a lot to them. I mean, it could be worth they built these high frequency lines to Chicago and back and whatnot. Like, yeah, it can be worth a lot to them to get, advanced order flow. Well, then JP Morgan's going to say, no, you're not. We're going to stop you from doing that because that would put us out of business. And they're going to buy the governance tokens. And then essentially what you have is the governance tokens become worth the stalemate, right? And so to me, that's an incredibly bullish situation. And that's my outlook for that. So that's my hot take there.
Awesome. Thanks so much for the hot takes. And thanks for joining us today. It was great to have you on.
It was awesome to be here. I love to I love to talk about crypto in the morning. So
thanks everyone for joining us today. And see you next time.
bye everybody.